Today, I am here with my guest, CJ Tarantino. CJ runs and is the founder of Tarantino CPA firm. And we are going to talk about his work with real estate investors. His boutique CPA firm specializes in working with high net worth individuals and specifically real estate investors. So today we're going to overview a few tax advantage strategies for real estate investors. We'll talk about cost segregation studies, 1031 exchanges, how the right entity setup is critical in your tax planning, the difference between a tax advisor and a tax accountant. We're going to talk about some of the maybe misunderstood or unknown tax advantages that you could use, like the tax credits for your children working for you. We'll talk about the real estate professional status, and there's so much more. I hope you enjoy today's show.
Welcome to Growing Empires. I'm Jennifer DeJesus, real estate investor and operator. This show takes you behind the scenes of how real estate assets are executed, managed, and positioned for long-term performance. Let's get into it. So welcome to the Growing Empires show. We're back again, and I'm here with Charles Tarantino, otherwise known as CJ. He's the founding and managing partner of Tarantino CPA firm. And for expert tax advice and strategies for real estate investors, I asked CJ to join us today. So CJ, welcome to the show.
Thanks so much for having me. Really excited to be here and share some information with your audience.
Oh, absolutely. And I'm excited too. We've got a lot to cover today. We're going to talk about why real estate for tax benefits. We'll do tax preparer versus tax advisor questions. We're going to talk about depreciation, cost segregation. We'll get into the real estate professional status, and then, probably some tax favorable exit strategies for those investors that are looking to do just that. But I'm really excited to get started. So why don't we jump right in? So why real estate for tax benefits? For our listeners that are building wealth, whether you're new to building wealth with real estate or you've got a large portfolio, what makes real estate so uniquely powerful from a tax perspective as compared to other investments, CJ?
So I think it starts with why the tax code is written. Inherently, it has advantages for investing in real estate to incentivize people to do just that, right? And you'll see other things where they disincentivize investment in like things like tobacco, where they tax that heavily, right? So real estate is one of those where it's very favorable. There's built-in advantages that we'll talk and kind of go through and unpack. There's kind of some key pillars with real estate, right? So there's you invest in appreciating asset, right? So you buy the right deal, it's going to appreciate in value. You also are going to get cash flow from that asset, again, if you buy the right deal. And then depreciation, which is a tax concept that we'll unpack. That's really kind of the magic around real estate tax benefits.
Fundamentally favoring real estate over pretty much any other asset class.
Yeah, so I think, one other nuance that, most people associate with real estate that's different from other assets you can invest in, right? So everyone's like, how do I maximize my resources, right? You want to invest in things that's going to grow your wealth. One key unique ability with real estate as opposed to like investing in stocks is the ability to use leverage. So you can buy an asset, say $1 million asset, put 20% down, use debt to finance the rest, and you can use leverage to get a bigger asset. Depreciation runs off of the purchase price of the asset. Being able to use leverage to get your value to stretch further. Whereas like if you invest in stocks, if you put 200,000 in, you have 200,000 worth of stocks. So that's one other key nuances that kind of leans in the real estate bucket.
Oh yeah, great point. Something to think about for sure. So what are the primary mechanisms that allow investors to generate millions in cash flow while still showing a net loss on paper?
It's really this magic word of depreciation. A lot of people are familiar with it, but when you start going into like how it works, it kind of confuses people. There's a lot of misunderstanding around it. Really what it is just a tax loss. So it's not an expense that you pay for like operations and you have insurance and taxes. Those are things you outlay cash for. Depreciation is just a tax concept that helps shelter your rental income. For example, you buy a piece of real estate, say 500,000, a portion of that's going to be allocated to land that doesn't factor into depreciation, but the remaining portion will. And so say $500,000 asset, say 100,000 is land, just to make the numbers easy. 400,000 is now your bucket of depreciation that you can take. Depending on what type of asset, it's going to have a different category of how long you take that depreciation. 27 and a half for residential, 39-year for commercial real estate. You're going to recover that 400,000 over that period of time. There are ways to accelerate that and kind of supercharge depreciation, which I'm sure we'll get into. But really what it is now you take that depreciation expense and use that against your rental income to help shelter that income.
Since depreciation is one of those favorite word for real estate investors, why don't we jump right into cost segregation since we're talking about depreciation, because it seems like the next logical thing to talk about. Tell me about depreciation as it relates to cost segregation and why a cost segregation study makes sense for real estate investors.
Well, I'll unpack that and maybe also when it wouldn't make sense. A lot of times it's kind of pitched as a no-brainer, and in most cases it is. In my example, you have a $500,000 asset, 400,000 of depreciation. Let's say you bought a residential property. That 400,000 is going to be recaptured over 27 and a half years. Now you can say, hey, how can I speed that up? I want more depreciation right now. That's where you would get a cost segregation study done. You need to work with a specialist that can handle that study for you and put together the necessary documentation around it. We introduce our clients to very qualified people in that regard. What that does is they look at your property and they're breaking it out in determining what can be broken down into other components. It gets pretty technical, but really what you're looking for is what buckets qualify for accelerated depreciation and what's known as bonus depreciation. A lot of the headlines last year were around 100% bonus depreciation being back. The one big beautiful bill brought that 100% bonus depreciation back indefinitely, so that's great news. You can plan around that. And all it does is the cost segregation opens up the door for what qualifies for bonus and allowing you to take a bigger deduction. So use my example where you had 400,000 of depreciation available. Average, it could get you 80 to 100,000 of that upfront in the year that you do the study. So really powerful planning tool. You want to plan around when it's best to use that. Maybe you have an income event somewhere else where you need that level of loss. So really powerful tool in kind of way to supercharge depreciation. That's really what cost segregation is doing. When you would maybe want to think twice about it, and that's why it's really important to work with someone that really just understands your goals, is that if you have a short timeline of the acquisition and you intend on selling pretty quickly, you may not want to use a cost segregation study because then you would be required to recapture that depreciation and it may put you in a bad spot that you then may have to plan around. So as long as you have a longer term horizon for that, generally cost segregation is a no-brainer. There are some nuances at the individual level of how does the loss apply to me? And that's where like real estate professional status comes into play. And I know that's on our agenda to unpack.
So you mentioned that you recommend or refer people to specific cost segregation experts that you're working with. How important is it the company that you choose to do the cost segregation study? Because anybody can pull up Google and get some information. So how important is that cost segregation specialist as it relates to the real estate investor's risk?
I think it's very critical to work with the right company to do that and the right CPA that can help implement it, because these are not small numbers that we're talking about. In my example alone, that's potentially a $100,000 deduction that you're putting on your tax return. You want to make sure that you have the documentation behind it. A lot of people get, scared around audits, and they can be if you don't have the right documentation in place. If you have everything buttoned up and you're like, hey, this is why I did this. This is why my return looks as such, because I followed everything. I worked with the right people. They helped me put this plan in place. It's a stress-free type of situation. So definitely recommend working with the right person. There's a lot of do it yourself or kind of shortcut the process. And just my own opinion is it's not where I would try to shortcut and save dollars. Is I would get the legitimate study, get it done right, and just have that documentation for your records.
Right, because the outcome is an audit, right? If it's done wrong, if you try to shortcut it, right, it's an audit, and then it's a problem.
The exposure is that you get audited and then they reverse what you did, or they challenge it, or like, hey, that's great that you put that in your return, but we don't respect it. And that's a bad situation. And they reverse what you did. They assess penalties and interest and all that. So not a road I would go down. And usually if you analyze, okay, what's my tax savings in terms of dollars, it far outweighs the cost of implementing strategy itself.
When does somebody do a cost segregation study for best use? Is it immediately upon buying a property, like within the first couple of months?
That is most common, is just a cleaner process in the year that you place it in service, but not to say that you can't do it if you're like, say it's an existing asset that you've owned for a while. It's just a kind of another step that needs to be done. Basically, you've been taking depreciation a certain way, and now you're doing a cost segregation study. You need to recalibrate, and there's a separate form and documentation that goes along with that, but can be done. So it's just cleaner to kind of do it in the year that you place the asset in service or acquire. So that's the cleanest approach. But really, I think the premise is planning. When is it most beneficial for you to do a cost segregation study? How does that piece fit into just your overall situation? What are your income sources? That's why a lot of times the planning we do is putting together a projection of, hey, here's your full picture, and modeling out scenarios. Here's what it looks like if you do a cost segregation study. Here's what it looks like if you don't, and kind of modeling that out. So really it comes down to, how do you benefit from doing it in your situation exactly?
Good to know. Now, we talked about when somebody might not do one. What about the types of assets that may not apply?
If it's real estate, cost segregation is going to be something that you can consider. Certain assets have more favorable benefits than others, just inherently. If you're looking at certain locations where land values are higher, maybe like markets in like California or maybe even New York, the land value may be high and may limit the depreciation benefits. You can often look and see what the details are there, or certain asset classes such as gas stations or car washes or something, they have more favorable depreciation benefits. There are some nuances with the specific asset, but if it's real estate, cost segregation is something that you can look at and see how it benefits you.
You had alluded to tax preparer versus tax advisor. So I want to talk a little bit about that, because there's a huge difference. And I don't necessarily think that everybody understands that. There's a person that you go to file your taxes prior to April 15th. And you gather all your stuff, you talk to them once a year, and you pull everything together. They ask you a bunch of questions, your taxes are filed. And then there's a tax advisor. Can you explain the distinction and why that matters for real estate investors?
It matters because you should really know who you're working with so that you make sure you have the right services and the right professional for your goals, and make sure that you're not missing anything. If you're not working with the right person, maybe something's being overlooked. When you get to a certain point in real estate, you really need to work with someone that's real estate focused, that many of their clients are in real estate. They understand it's kind of its own world. You can work with a generalist that'll kind of only get you so far. Tax preparer versus a tax advisor. I think most people think of an accountant in the traditional sense as like a tax preparer. Hey, I bring them my documents in February, March, April. They prepare my return. They tell me what happened, and hopefully it was good news. That's a preparer. It's more so just making sure you're within compliance. Your returns filed every year. You're not in bad standing with the IRS. A tax advisor is more proactive, future focused. For example, we're in 2026. What are you doing now to help you in 2026 that when you file next year's taxes, you have created a favorable result? So it's more planning focused, more consulting focused, and not every preparer is an advisor. Some firms are built around of clients, and they do a lot of returns, and they don't have the capacity or bandwidth or expertise to be able to advise you and consult and help you structure things, help you understand the tax implications of certain things. I came from big CPA firms before I started my own a few years ago. And at the big firms, we serviced really big clients, and we were kind of trained and built up to be both. We do the compliance side of it, but also if our client has a question, we're going to consult on that. So you just want to make sure you understand who you're working with. You're signed up for the right service. If you need planning, you have things going on, you can benefit from it. You definitely want to make sure you're working with someone that can help you with that.
And would you say, CJ, that there is a difference even between a tax advisor and a tax advisor that specializes in working with real estate investors?
100%, 100%. So
Yeah.
it's kind of like you go to a doctor that's a specialist, right? You have a specific issue, like, oh, my shoulder hurts, right? I need to go to someone that specializes in helping people rehab shoulders. I can't go to someone that doesn't do that. Maybe they know a little bit, but they're not going to be able to get me to where I need to go. It's the same thing with CPAs. There's a lot of great generalists out there. They kind of know a little bit of everything, but if you're heavily, which a lot of my clients, they're hyper focused on real estate. Maybe they're a little bit diversified, but really the premise of what they do is invest in real estate. You want someone that their client base is centered around that. We're seeing the reps, we're seeing all the nuances, we're seeing the rule changes, we're seeing how that affects clients. And so we're able to come alongside you and give you the tailored guidance specific to your industry. So I definitely recommend making sure you're working with someone that has that expertise.
I can tell you from personal experience, I have changed CPA firms multiple times over the years, and not always for any particular bad reason. It's just as my real estate and portfolio grew, as my holdings grew, I was maybe not getting the best, most critical tax advice as it related to making sure that I can keep more money in my pocket. I can definitely attest to that there's a big difference there, and it could be. And as you mentioned, it doesn't mean that the CPA firm that you're working with is not super knowledgeable about tax generally, but as it relates to real estate investors, it's a niche market for sure.
Yeah. And then just also making sure a kind of good test is like, what's your communication with your accountant or CPA? If it's just around tax time, then either they are a preparer or you maybe haven't engaged them to do advisory, and you should ask, how can I benefit from that? And if they can't, then you look for someone that may be more equipped for what you need. If you're doing adequate planning, you should be talking to your accountant a few times at least throughout the year, especially as it gets closer to year end of, hey, what can I be doing to lower my tax bill? I don't want any surprises next year when I file. Can you outline the few most important things I should be thinking about?
So is there like a day-to-day operational difference between your advisor and your tax preparer? Or what is a true tax advisor as it relates to real estate? Like, what do you do differently when you're working with real estate investors? How often do you communicate with them? What's your style? Give me a little bit of background on that.
I think with a preparer, it's going to be, hey, around tax time, I'm asking for your documents. May have questions throughout that process. Like, we're pretty thorough in just the preparation process because we are trying to make sure everything is captured and done correctly. And if there's anything that we can take advantage of, we will, but it's reactive. The past is the past. It's already happened. And we're just trying to put the pieces into place. Advisory function, what we see kind of the sweet spot is usually like a quarterly cadence is when we're touching base with clients. Some clients have a lot going on, maybe more, but usually quarterly, at least 3 times a year, usually around tax time, mid-year, and then year-end planning as well. I would say what we do a little bit differently is we're future focused. We're modeling out what is your income expected to be? What key things do you have happening? And what are some things you should be thinking about to reduce or mitigate your tax burden? And then also just mapping in, what are your goals? Is your goals to build this big portfolio? Because we can't make recommendations that don't align with that. So it's really, hey, what are your goals? What are the tax strategies that align with that? And how do we get you into a situation where your tax situation is optimized for your goals?
Great insight. So I'd like to jump into what I believe is the hot topic of all the things that we talk about, or at least the thing that I definitely hear more questions about, and that's the real estate professional status. That seems to be a game changer for some investors. Who qualifies and what does it actually unlock?
Yeah, great question. There's a lot of confusion around this. Real estate professional status was really something that was formed in the 80s around the passive loss limitations. So without getting too crazy in the weeds, they basically created different buckets of income types: active and passive. Actives, like you have a W-2 job, a business that you're actively involved in. Passive is what real estate defaults to, meaning that your income or loss will be deemed passive and it cannot default off that active income. It's separate. So real estate professional is the criteria needed to take that passive loss from real estate and have it offset active sources of income, which creates a really powerful result. The criteria is that you have to have at least 750 hours in a year. And this is what confuses a lot of people, is you have to have more time in real estate activities than any other area of your working time. So if you have a W-2 job, you're pretty much eliminated from that. They basically created these rules because high income earners would just go buy real estate and pay no tax. They wanted to make it a little bit more difficult. So 750 hours and more time in real estate than anywhere else that you work. It has to be documented. The documentation around this is critically important. If you're ever audited, they're going to ask for it. They're going to challenge it. So date, hours, what function you did, what's that look like, spelled out. There's a number of ways you can go about it. Spreadsheet, there's apps that can help facilitate this. But yeah, real estate professional is kind of the key to be able to take those losses and unlock them against your active sources of income and bypass those passive loss limitations. One key point I always like to make is that we have a lot of clients that maybe by the nature of what they do, they can't meet that criteria. But if you're married and you file jointly, you can create that same result. To give you an example, high income earner, maybe a doctor or a dentist, their spouse spends the time in real estate, they become the real estate professional. And now you go invest in real estate, and now you can create this really powerful result where your spouse has the real estate professional status, you take that loss and offset your active income, dentist, doctor, whatever income they're generating. So that's kind of a way around it a little bit. You got to have the hours. It's got to be documented, not something you can just put on your return. It would definitely be scrutinized.
As far as the real estate professional status, is there like a number one material participation mistake that people do that would cause the IRS to reject it?
The biggest thing is you don't have it documented and you try to throw it together retroactively. It's not advisable, not going to work. As soon as they see that and it doesn't look like it holds up, they're going to discount it. Something you want to manage proactively, build a system around to make sure you're capturing your time. And then we get tons of questions about, does this count? Does that count towards the hours? What does, what doesn't? It's really difficult to just say, here's a bucket of everything that counts. But kind of the framework that you can look at as to how can I know what counts or not is they want to see that you're involved in operations of real estate and not just pure investor. So not like, hey, I just kind of look at the finances once in a while and that's how I spend my time. They want to see that you are somewhat involved in some operations within real estate. Now, the best thing you can do is if there's anything you're confused about or gray area, just ask your accountant and say, hey, is this good? Is this legitimate? And then just as a safeguard, just include all your time and then just make sure that if there's anything questionable, make sure it's not like, hey, I have 751 hours to where if some of that got discounted, that you'd be in trouble. If you're confused, just include it and then just make sure you have a little bit more just in case some of it was to be thrown out.
Really good tips. All right, let's move on to tax favorable exit strategies. So many of our listeners have heard of or have completed 1031 exchanges, right? And then I know we have things like Delaware Statutory Trust. Is there anything outside of those two, CJ, that would be a tax favorable exit strategy for an investor that's looking to get out of a property, maybe buy another property, do different things with the real estate? Anything outside of 1031 or DSTs?
Just a kind of different spin on it. Piggybacking off of the beginning is why is like real estate great for tax benefits? It's one on the acquisition of depreciation, but then also very favorable exit strategies. How do I defer taxes? I sell a piece of real estate and I want to defer the taxes. These are built-in advantages for real estate. 1031 exchange is a very common one. DSTs work as well, if a more passive approach. One wrinkle is that if you wanted to not have the rigid requirements of a 1031 exchange. There's very tight timing requirements. You got to identify property or within 45 days, you got to close on that property within 180 days. Very rigid requirements. It's become kind of popularized as a lazy 1031 exchange is where you sell a property in a year and then you go and separately, not 1031, you go acquire another property and then you do the cost seg on that property, as long as you did that in the same calendar year so that the result matches up, you create the same result where you're sheltering the taxes. So property one, you sell it, you have a gain on the sale. Property two, you then take that and you buy another piece of real estate. As long as you do that and you place it in service in the same year, you could essentially do a cost segregation, create accelerated depreciation that would then offset the gain from the property one that you sold. So it's kind of like lazy 1031 exchange, gets around the rigid requirements of the 1031.
I've actually heard somebody say lazy 1031, but I don't think I actually knew what it was. That's a good one because I deal with this stuff every day. So the fact that I didn't know about that is interesting.
You got to be careful though. You got to be careful though, and that's why I just make sure you're working with someone that's helping you plan and map this out. Because if it's for whatever reason doesn't happen in the same year, now you've got a problem. Whereas the 1031, it's like foolproof. Like as I deferred, is rolling into that next asset very directly. You don't have to worry as long as you follow the requirements. Whereas this approach is just it's got to line up in the same calendar year, so it takes a little bit more careful planning.
Okay. Let's just dive into DSTs with a quick summary. The differences. Why a DST over a 1031, vice versa. Pros and cons.
Yeah, I think CST is a good thing to have in your back pocket for a couple reasons. One, the use case would be I want to defer the taxes on the sale of real estate, and I don't really want to have much involvement anymore. I want to treat this as pretty passive now. I think you would be considering that as an option. Or I have seen it done where a 1031 exchange, you need to replace the value, right? So whatever you sell, you have to replace the value and the debt, right? So there's a component there. If there's going to be a shortfall, meaning like I can't find an asset that's quite as valuable as what I sold, and you have a shortfall that you need to replace, some people will drop that portion in a DST just to like, hey, I do not want to pay any tax. So I'll go with whatever strategy I need to do to not. That's kind of a shortfall option as a DST. Great option for those use cases. And so it's just, hey, I'm looking to be a little bit more passive with it.
Last but not least, let's talk about some what I would consider to be some maybe lesser known strategies that people are using. Let's talk about paying your children to work. How can you take advantage of that?
This has become a little bit more common. A lot of people are attracted to this, are interested in it. We have clients that do it. So you got to do it right. Your child has to be performing a function that's documented. You pay them via a W-2 so that the trail is there. But why it's powerful is that you pay your child and you create a deduction on your business that you get to take a deduction for wages. And then you pay them under the standard deduction. So let's call it 15,000. Now they're not going to have income on their side. So your income shifting from your business to your children, and then take it a step further. You can take that money, invest it in retirement accounts that are tax advantage, help them grow their wealth. Really powerful strategy. It's just making sure you have it well documented, and it's not like, hey, I just pay my kids, they don't really do anything. You do have to have it documented and have some sort of function that they're doing. But in real estate, there's a lot that they can kind of help with. I would just kind of think what makes sense for your business.
You had a really great post about this particular topic, and you're like, you cannot pay your 7-year-old to be a consultant for your business. Like, that's not going to be something that's going to fly. But yeah, so it's essentially for work that your kids can really perform, right? So based on their ages and based on whatever your business is.
It's got to be reasonable for their age and their qualifications. So just making sure that that holds up. And there's court cases out there where people have gotten aggressive and challenged this. So it's something that's pretty clear as to what they're expecting. As long as they're doing a legitimate function that's reasonable for their age and you have the documentation behind it, definitely a legitimate strategy, and help teach them business lessons and grow their wealth on the practical side of things.
What about home office deduction? It's got quite the reputation for being a red flag, but do you consider this a legitimate tool that people are leaving on the table if they're not using it?
A couple nuances around this. I think it's been overblown as a red flag. I think there's like a generation of accountants that all think this is a red flag. Accountants I've learned from. I spent my career learning from CPAs that have been in the industry 30 years. And as I always heard the same thing. I think just today's day and age, it's very prevalent that people have like a home office and legitimate, but it's really just an exclusive space in your home for key business functions. It's very common now. I wouldn't say, oh, I put the home office deduction, I got to be worried. You do want to make sure that, hey, is it legitimate home office? I do think though, in a lot of like marketing and talking about it, it does get overblown as to like how beneficial it is. I think every little bit helps. So it's definitely something that you should at least know, hey, am I taking that on my return? How did that help me? It's not like something that major moves the needle, but every little bit helps. So if it's beneficial to you, you might as well take it. And if it's valid.
Well, let's talk about entity structures, because I know that this trips a lot of people up. I get a lot of questions about it all the time. And I'm always like, refer to your CPA or your attorney. However, how does a real estate investor know if they're set up correctly, whether it's an LLC, an S Corp, or any other version? How do you know what you should be in if you're set up correctly.
And you kind of hit the nail on the head with what you said. So your CPA or your attorney, those are two key people that need to be involved with your entity structure. We're looking at it from a tax lens. That's our expertise. And then you also want an attorney that's looking at it from an asset protection and legal lens. It works best when you have two of those in your corner that's looking at it from both sides. From our view, we're looking at it from the tax lens. First, it's what entity structure should you have? It usually comes to what is the entity designed to do? Is it designed to hold real estate? Then very commonly an LLC would be the best. It just has flexibility built into it to be able to move properties around without creating a taxable event. If it's more of an active business, or if you're flipping property potentially, or you're wholesaling or something like that, more active in nature, or just like a legitimate active business, an S corporation may be beneficial. It's really critical to know what kind of business, what's it designed to do, what's the income level, what's going to be coming through that entity. That helps understand what's the best one for it. A lot of people with real estate, they go crazy setting up all different entities and all these different things. Just understand that there's compliance requirements as a result. My framework and recommendation is, how can you keep it simple but achieve the result of ultimately you're doing this likely for asset protection and liability protection? How can you create like the most simplified version that holds true to what you're trying to do, to where you don't create where you have 17 different tax returns and all these added costs that you really didn't need?
Isn't it something to consider too? Because I can see how an investor could potentially cross the line from passive real estate to like an active business structure that would trigger like self-employment taxes. Doesn't your entity structure kind of set up also have an impact on, are you operating a business or are you operating real estate? So I'd imagine that that's some risk you got to talk to your attorney or your CPA about as well.
Yeah, and I think just to come full circle, this is why it's really critical that if you're doing these types of things, that you're working with an advisor who can look at your situation, have a conversation. Okay, what are you looking to do here? And they can give you a very tailored recommendation. Because you are doing flips and you're going to hit this level of income, I recommend X, maybe a S corporation. S corporation, for example, is where you're going to look to save on some of that self-employment tax. That's primarily what like a vehicle like that would do. There's not necessarily like blanket catch-all tax advice, which a lot of people will see things online and it's like, I'm just going to take that and run with it. You could get in trouble with that. Even like with the prevalence of AI now, a lot of people will start like looking on AI. We use different AI features for like tax research and different things, but it really takes understanding the nuances of your situation. I had a call with you a year ago and you told me X, Y, and Z. So I know that like this doesn't work for you because of that. It's understanding holistically your situation and goals that you'd get the best advice for you.
Oh, so true. It's funny because I was literally going to just ask you, how has the world of AI made you crazy? As it relates to everybody now has their CPA, degrees because of Claude and Gemini. Like you said, AI can be used for tactical things and for some basic information, but you got to rely on the experts to make sure that you're getting the best advice. I always find it interesting when I hear people talking about saving a dime and not doing their own LLC setups or setting up their own entities. Like they could just go on LegalZoom and do it themselves. Or they can find a cheap cost segregation analyst out there that'll do it pretty much online. I kind of just shake my head and say, I don't know if I'd be doing that, because your risk is your wealth, right? Your risk is your wealth. It's everything you're working for. Really good points regarding professionals throughout our segment today that I think are critical. In closing, I'd like to ask you one big power question. If somebody listening does only one thing different with their taxes this year, what would you want it to be? They have one chance to get it right. One thing different. What would it be?
Really good question. And what I would say is that they would take a more proactive approach to their tax situation and understand that the people that are saving the most and that are paying the least in taxes are doing that. They are investing in that function where, hey, I want to work with someone that's going to help me get ahead of the curve. I'm not going to be the one that is just going to drop off my documents, hope for the best, and we'll see what happens next year. Take a proactive approach to your situation. Ask your CPA, what can I be doing? I heard the cost segregation is a thing and depreciation. Am I optimizing that? Is there something I should be doing more than I'm doing now? That's would be my recommendation.
CJ, where can people find you or learn more about working with you?
So on social media, CJ the CPA. Then you can also go to our website, tarantino-cpa.com. If you are interested in seeing how we can help, we do a free discovery call, just really understand your situation. We'll collect some information from you too to really just see what's going on. And then just unpack your situation and see if we'd be a good fit to help you and if we can add value.
And I definitely will be referring people over to you, as I already have, but I'll definitely be continuing, because I'll tell you, every time I've talked to you, CJ, you are just a boatload of information, and I can tell you just eat, sleep, and breathe this all day long. So it's really refreshing to talk to somebody that really takes pride in their expertise in working with real estate professionals and real estate investors. You clearly do. So thank you for that. Thank you for all the information today. I appreciate your time.
Yeah, really appreciate you having me. And yeah, thanks so much.
That's it for now. If passive income from real estate investments plays a role in your long-term investment strategy, this show is for you. Thanks for listening. And for more in-depth resources, please head over to growingempires.com.